Good morning. Let's break down how the stock market connects to your life. Imagine a giant company as a huge pizza, sliced into millions of pieces. These are shares, or stocks. When you buy a share, you own a tiny slice of that company. If the company grows, your slice becomes more valuable, and you can sell it for a profit. This buying and selling happens on the stock market, where prices constantly move based on news and investor confidence. But prices can fall too. Bad news or poor performance can make people rush to sell, driving prices down. That's the risk. Your investment's value can change quickly. When we say the market is up or down, we're talking about the average value of all these shares, often tracked by indexes like the STOXX 600. If the value of the index drops, it signals a broader economic downturn. Understanding this is key. A single announcement can ripple through the entire financial world. The stock market isn't just for Wall Street, it's tied to your financial future. Let's see who the main players are. To understand today's news, let's meet the main players. First, the banks. Giants like Barclays and HSBC. They don't just hold savings, they lend money, especially through credit cards, earning big profits from interest and fees. Any rule change on credit cards hits their bottom line fast. Next, former US President Donald Trump. Even out of office, his statements can shake markets worldwide, especially when he targets industries like credit cards. Then there's the US Federal Reserve, or the Fed, led by Jerome Powell. The Fed sets interest rates, influencing borrowing costs for everyone. It's supposed to be independent, making decisions based on data, not politics. Any clash between political leaders and the Fed makes investors nervous. Finally, individual companies matter too. AstraZeneca, a pharmaceutical giant, can see its stock move based on news or index changes. Smaller firms like Abivax can skyrocket on a single drug breakthrough. So, while big news moves the whole market, each company's story counts. These players, banks, politicians, central banks, and companies, shape the market's every move. Understanding who's involved helps explain why markets react the way they do. Now let's look at what set off the latest market shock. The stage was set for a dramatic shift. Here's what happened. The spark? President Trump proposed capping credit card interest rates at 10% for a year. That's a huge change. Current rates often top 20% or more, especially for those with lower credit scores. For millions in debt, this could mean real relief and extra money in their pockets. But for banks, it's a bombshell. Their profits rely on charging much higher rates. A sudden cap would slash earnings and upend their business models. The proposal's quick timeline and lack of details only add to the confusion. This uncertainty sent shockwaves through the financial sector. News of the proposed cap hit banks hard and fast. Credit card interest is a major profit source. Cutting rates to 10% is like slashing the price of their best-selling product. Investors panicked, selling off bank shares. Barclays dropped 4.5%, its lowest in a month. HSBC fell 1%. Billions in value vanished in hours. The fear isn't just lost profits, it's about what comes next. Banks may tighten lending, making it harder to get credit cards, or raise other fees to compensate. The uncertainty over how banks will adapt only fuels investor anxiety. When the future is unclear, markets react quickly and harshly. This is why a single policy proposal can trigger a sector-wide sell-off. The market hates surprises, especially ones that threaten profits. And this was a big one. Why does US news rattle Europe? Because the global economy is a tightly woven web. American policy changes hit European banks like Barclays and HSBC, which have huge US operations. A US interest rate cap directly impacts their profits, no matter where they're headquartered. European investors watch US headlines closely. What happens in America affects their bottom line. Fear spreads fast. If US markets drop, European investors get nervous too. They worry similar rules could come to Europe, or that a US slowdown could hurt exports. This risk-off mood leads to broad sell-offs, not just in banks but across markets. Good or bad, U.S. news moves global markets. Capital flows freely, and companies operate worldwide. A single U.S. announcement can ruin a British banker's day, or a German retiree's savings. That's the reality of our interconnected financial world. Let's see how individual companies fared in the shakeup. Let's zoom in on the day's winners and losers. Barclays took a 4.5% hit, millions wiped out in hours, because its U.S. credit card business is so exposed. HSBC dropped 1%, cushioned by its global reach, but still felt the sting. The whole banking sector was under a cloud of uncertainty. AstraZeneca, meanwhile, slipped nearly 1%, not because of credit cards, but after losing its spot in the Nasdaq 100 index, forcing funds to sell its shares. It's a reminder index changes can move stocks too. But not all news was bad. French biotech Abivax soared 22.8% after its CEO touted a promising new drug. Sometimes company-specific breakthroughs can defy a gloomy market. The day's moves show how both big headlines and individual stories shape the market. Even in a downturn, there are bright spots for some. The market is a mix of broad trends and unique company news. Let's look at what these swings mean for you. Market drops aren't just a problem for Wall Street. They hit your wallet too. Retirement savings like 401ks and pensions are invested in these markets. When stocks fall, so does your nest egg. A small drop may not seem like much, but repeated downturns can shrink your future income, especially if you're nearing retirement. That's why advisors suggest shifting to safer investments as you age. Market swings also affect jobs. Companies facing losses may freeze hiring or cut staff. And if a credit card cap passes, it could help those in debt, but banks might make it harder to get credit. Every policy has trade-offs, and market moves ripple through the whole economy. Understanding these connections helps you make smarter financial choices. Another source of market anxiety? Tension between the Trump administration and the Federal Reserve. The Fed, led by Jerome Powell, is supposed to be independent, making decisions based on data, not politics. But recent threats from the administration, like talk of indicting Powell, raise fears of political interference. Investors worry, if the Fed caves to pressure, it could lead to bad economic policy and instability. This political risk makes global investors nervous, fueling more market volatility. Combine this with the credit card cap proposal, and you get a perfect storm of uncertainty. Markets are being hit from two sides: direct threats to bank profits and doubts about the Fed's independence. That's why investors are so cautious right now. When politics and finance collide, markets get jittery. The result? More unpredictability for everyone. So what's next? The banking sector faces big questions. Will Trump's credit card cap become law, or is it just political theater? Banks are preparing for both scenarios. If the cap passes, expect tighter lending and higher fees as banks adapt. For companies like AstraZeneca, index changes are short-term blips. Their future depends on innovation and performance. Abivax, riding high on drug news, must now deliver results in trials and approvals. For everyday people, this is a reminder to stay financially aware. A credit card cap could help with debt, but might make credit harder to get. Market volatility highlights the need for a diversified, long-term investment plan. Don't panic during downturns. Stick to your strategy. The markets are waiting for clarity. Will the Fed stay independent? Will the credit card cap move forward? Until then, expect more caution and volatility. The past week shows how fast things can change, and how connected we all are. Everyone, from world leaders to families, will be watching what happens next.